Right across the S&P 500, we see nearly every stock down and quite significantly. However, our focus in today's episode is on Booking Holdings that reported after the market closed yesterday, and today we can see they are down around 7%, and in fact just over the last few days they are down around 10%. So let's find out, is this undervalued high quality company a buy, or do we have some cause for concern? So in terms of the earnings, as we can see, the headline does show us that they did beat both their Q2 EPS as well as their revenue for the quarter. And when we take a look at the numbers, well, earnings per share, $41.90, not only beating analyst targets of $39.39, but as we can see, a very nice increase from the same quarter last year at 37.62. So positive to note, EPS increase on both analysts as well as the same quarter last year. And when we take a look at the revenue, nice $5.86 billion for the quarter. As we can see, a beat of 1.36%. And more importantly, when we compare it to the same quarter from last year, $5.46 billion. So again, a double beat, very strong. On top of that, as we will show later on in the episode, they have in fact beaten over the last 4 quarters analyst targets. Always a great sign to note. Another few highlights from the second quarter results. They talk about how the room nights booked has increased up around 7% from the previous quarter. Their revenue, which we just said around the 5.9 billion mark, is an increase from 7%. Again, that is from the previous quarter, not from last year, but just from Q1 of 2024. We also note a very nice increase to the net income, 18%, and that is from the prior year quarter. And earnings per share, as we mentioned, very strong, around $44, up strong double digits, 27 in fact, from the prior year quarter. So overall, whichever way you look at it, the numbers do look very strong for Booking Holdings. And ultimately, we want to understand, should we consider this in our portfolio? Now, it does get a double buy rating and a hold from Quant. It now trades in the mid to lower end of the 52-week range, and it does have a forward yield sitting at just below 1%, with a forward P just below 21. S&P right now does sit around 22. Now, when you want to look year to date, this is a company that is down around 4%, so has significantly underperformed the S&P. Over the last 12 months, again, not the greatest performance, up 16.82%, but when we zoom out over the last 10 years, it has marginally outperformed the S&P 500, and we can see all-time highs again this year, sitting around the $4,100 mark. Now let's look under the hood, understand a bit more about the underlying metrics. Now, as they've just started to pay a dividend, as we can see, about a 1% yield, we don't have a dividend safety score, but we will update you when we do get that number over the next few quarters. In terms of the free cash flow payout, as always, we want it below 60% to give us faith they can offer incredible increases year on year. In fact, 17% over the next 12 months, that is a low payout ratio, and we would anticipate with Booking Holdings moving forwards, nice double-digit increases to the dividend. One thing that we really like about this company is the free cash flow. As always, we want consistent increases over the longer term. Absolutely no surprises during the COVID period, 2020 and 2021. We didn't see the greatest free cash flow, but when we look and zoom out, it has increased around 4 times from 2014 to 2023, and anticipated over the next 12 months to continue the upwards movement that we do want to see from this company, and just a general point for this metric. Then we move to the sales growth. Double digit has what we see pretty much on a year-on-year consistent basis. 3 to 7% is the real minimum we want to see from any company. Again, no surprises during that COVID period, especially given the industry this operates in, the negative 55% in 2020. And what is nice to note, it rebounded very strongly in 2021, and even though it has started to slow down, 25% in 2023 and 21% on a trailing 12-month basis does look very, very strong. Numerically as well, looking very nice, around 3 times growth over the last 10 years. And on top of that, what we really like to see, a lot of excess cash returned to investor pockets, buying back shares, 53 million, which isn't a large amount to begin with, down to around 36 just in that latest quarter. So that is something we love to see, as that is a very nice addition to the dividend that Booking does offer. ROIC as well, remember 10% or more, give us faith, management are able to effectively allocate their capital, consistently very, very strong, 29% in 2022, 47 in the more recent year, and 46 on a trailing 12-month basis does make it an incredibly attractive proposition to potential or current investors to add more. Margins, remember 16% as a bare minimum. Now we have seen it decrease over the longer term. Ideally, high quality companies can increase their revenue as well as operating efficiency, increasing the margin over the longer term. Something to bear in mind, however, from the COVID drop to 7%, it has started to increase, and we can note on a trailing 12-month basis, 29% does look good. Something just to keep in mind though moving forwards. Free cash flow margin, very, very consistent, mid-30s nearly every single year. That is a phenomenal metric, as well as very strong consistency throughout. Finally, we get to the net debt to EBITDA, the earnings before the interest, tax, depreciation, amortization. Remember, correlates to both dividend safety, balance sheet strength, and these are the number of years it would take the company to pay off all of their debt net of cash on hand. 0.31 in 2023. We want to see below 3. 0.17 over the next 12 months. Incredible balance sheet, dividend definitely secure, and overall we do believe, based on these metrics, it does look like a high quality company. Now, a few other things that we want to point out: insider movement as well as institutions. We'll start off with the insider ownership at 0.12%, but we do note around 49 million worth of sales by these insiders over the last year. And when we look, one thing we would say, even though in the more recent quarter we see 3 million worth of sales, this isn't something that is surprising, as we can see pretty much every single quarter there is sales by insiders. Now, as we said, in the more recent, around 3 million, and for those that want to see those insiders who they are, we note the CEO in fact sold around 750 shares for around $3 million, and we can see that was on the 15th of July, so just a couple of weeks ago. As always though, we don't believe this to be a bearish signal. Insiders do sell for many reasons, both personal and financial. Quite a high institutional ownership, 92% in fact, 69 billion worth of sales over the last year, which is significantly more than the amount of buys of 9 billion over the same time period. So overall, we can see institutions have been selling a lot more than they have been buying, although we note in the more recent quarter just a little bit more buying than selling, but Q1 we can in fact see a significant amount of sales in comparison. Regardless, institutions or insiders buy or sell, always do your own due diligence. Just something though that you can use if you want for the wider piece of your investment thesis. We also want to let you know we have released our latest weekly articles. If you want access to any of this, you can click on the pinned comment below. You can start reading straight away for free. Now let's move on with this company and get into some of the numbers. Now the income statement, as we just mentioned, the top line revenue over the longer term is moving in a very strong direction, up around double digits nearly every single year. But we want to understand, is that same story to be told on the bottom line net income? And in fact, we can see around 2.4 billion in 2014, 4.3 in 2023, and we can see it, other than that COVID drop and the rebound over the longer term, it is moving in the right direction, and hopefully this is something we can see some more consistency, as no surprises that COVID does look like it was a one-off affair that did affect their numbers quite severely, and no surprise again given this industry that the company is in. We then want to take a look at the health of the company, total cash versus total debt. They had around 4.3 billion sitting on the balance sheet in 2014, 16.3 in the latest quarterly report, so it has increased 4 times. Again, no surprises, it does follow the trend of the revenue and has been increasing over the longer term. Now remember, in isolation, any of these numbers don't tell us anything, which is why we compare it to total debt numerically and directionally, and we can see here 3.9 billion in 2014, 17.3 in the latest report, and that again following the trend of the other metrics has been increasing over the longer term. Now, as we just saw, the net debt to EBITDA metric is very strong. It is below, in fact, 0.5, so no worries so far based on this information. The balance sheet does look secure. We then want to point out the earnings moving forwards as well as historical performance. Over the last 4 quarters, including this one, they have beaten 4 out of 4, so that is very strong. 100% track record, not just on EPS, as we saw at the beginning of the episode, also on the revenue estimates as well. Moving forwards, a little bit of a mismatch. Some quarters they are anticipating single digit, others double digit. Overall though, if they do hit the EPS estimate for December 2025, the forward P is anticipated to come down to around 18. So overall it does look good, but again, it will depend on if you have faith on management to continue that nice track record of beating the target. We then move on to the valuation. Now they score an F. One of the reasons for this, when we do look at it on a P non-GAAP basis, around 21, whereas the sector median around 15.6. So this tells us that Booking Holdings right now is trading at a premium of 33%. Whether or not you believe it is justified, something we can factor in as well as into our margin of safety. But overall, that is the trend on whatever valuation metric you use. Booking, in comparison to the sector, does trade at a fair premium. We then move on to the grading for the growth, where they get a B+. Nice to note then, and understandable why essentially they do trade at a premium. Revenue year on year, 21%. Sector as a whole, 2%. Revenue moving forward, around 14%. Sector median, low single digit. And as always, when we draw your attention to the earnings per share, Booking Holdings around 19% year on year over the next 5 years. In comparison, when we look at the sector, lower at 11%. So overall in the growth, they do significantly have better results, better metrics than the sector median. We then take a look at the profitability. Again, very strong. They get an A+. Gross profit margin, very high, around 85%. Sector median, 36.5%. Bottom line as well, phenomenal 22%, sector median around 4.77. And we also like to point out their cash from operations above 7 billion, with the sector median around 264 million. Finally then, for a quick wrap up for this part of the analysis, double buy with the hold from Quant, an F on valuation, B+ on growth with an A+ there for profitability. Finally, before we jump into the valuation, we want to compare this against others in the industry of a similar size. Now, consumer discretionary hotel resorts, we have Airbnb, Marriott, Hilton, as well as a few well-known others. And what we can see, looking over the last year, including dividends reinvested, Booking is up around 17%. Now, it is in the mid-performance of those that we have seen today, and when we extend it over the last 5 years, we can see, again, very similar. They do tend to be in the middle of the 6. When we zoom out even further to over the last 10 years, again, pretty much there consistently over the last 10 years, and when you do look at it on a year-on-year basis as well. Whether or not you believe over a 10-year period this is a very strong result of 167%, do factor in that past performance is never an indicator of future performance. As always, if you enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. And our intrinsic value today comes around $4,300. Now, how we got to this value, we did put it through the DCF model. We have the free cash flow year on year. Again, average growth rate, it is skewed given there are some years where it has gone from a negative to positive. We've essentially gone for 3 different growth rates, which we believe to be incredibly conservative. But as always, let us know your thoughts below. A low of 2%, medium of 4%, and a high of 6%. Now today we've gone for the medium of 4 in conjunction with the discount rate. We've got the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as we can see, an undervaluation signal. So if you believe 4% free cash flow over the longer term, well, from this price right now, there is 27% upside. There may be some people that say, that is a little bit optimistic. We may be heading into a recession. Consumers with the weakening environment we are seeing through the results of those earnings, for example, Hershey, McDonald's, Starbucks, that maybe actually we should be looking at 2%. 2% therefore takes it to around 3,712, which as we can see, still upside, but very low. And there'll be others that believe these numbers are way too low. And as we can see, 6% for essentially transparency, $4,965, upside of 46%. As always, depending on what you believe, fairly subjective, so you can grab a copy of the model by clicking on the pinned comment below. Whether you want to put in essentially numbers for Booking or others in your portfolio or watch list, you can do that as well. So let's take through the mid rate of 4%, and when we get to the intrinsic value, we always add a margin of safety. Now we start off with 10% and we execute on this if it meets our 3 golden criteria. Wide moat, strong financial metrics, good forward-looking data. Now if you believe that for Booking Holdings, we'll buy at 3,865. Then we keep going till it's near the current trading price. and what we can see in today's episode, pretty much at a 20% margin of safety. Now with Wall Street, they believe the price target over the next 12 months, not too far off our intrinsic value around $100. They have upside of 24%, and as we saw, both Wall Street as well as Seeking Alpha do consider this a buy. So a quick summary, we have a 20% MOS, upside of 24%, but as always, let us know your thoughts in the comments below. Is Booking Holdings one that you find attractive at this level, 20% margin of safety, or is this one that maybe you are waiting on it to come lower if you do see us heading into a recession over the next few months? As always, if you enjoyed today's content, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Don't forget to click on the pinned comment below so you can sign up to the newsletter where we send out lots of undervalued stocks to consider, or join us in the Patreon as well if you want to talk about our weekly buys and sells. As always, we'll see you all in the next one, and for now, take care.